Pratika, and I'm going to talk to you about course MB 2203 Financial Management. On this session, we will cover Capital Asset Pricing Model or CAPM. The Capital Asset Pricing Model or CAPM is the basic theory that links risk and return for all assets. The CAPM quantifies the relationship between risk and return. In other words, it measures how much additional return an investor should expect from taking a little extra risk. Before we go further about CAPM, we need to know about risk. Total risk is the combination of securities or assets non-diversifiable risk and diversifiable risk. Diversifiable risk is the portion of an asset's risk that is implied to firms specifically. It is also called unsystematic risk, and it can be eliminated through diversification. The other risk is non-diversifiable risk. This kind of risk is the relevant portion of an asset's risk embedded to market factors that affect all firms. It is also called systematic risk. It cannot be eliminated through diversification. And because any investor can create a portfolio of assets that will eliminate virtually all diversifiable risk, the only relevant risk is non-diversifiable risk. The next thing we need to know is beta coefficient. This is a relative measure of non-diversifiable risk. It is an index of the degree of movement of an asset's return in response to a change in the market return. The market return is the return on the market portfolio of all traded securities. An asset's historical returns are used in finding the asset's beta coefficient. The beta coefficient for the entire market equals to 1. All others beta are viewed in relation to this value. You also must be aware that the CAPM relies on historical data, which means the beta may or may not actually reflect the future variability of returns. Here we have the beta derivation graphics for asset S and asset R. As it mentioned before, the beta is a degree of asset return to market return. By plotting market return and asset return for each asset, we can see the characteristic line for both assets and betas shown by the slope in the graphic. Steeper characteristic line slope or higher beta indicates that its return is more responsive to changes in market returns. Therefore, here, asset S is riskier than asset R. You can see here that the slope in asset S is much steeper than asset R. Calculating beta for portfolio is similar to calculating its return. We must multiply each beta, the weight of an asset, based on its proportion in portfolio. Now that we know about risk and beta, here's the formula for the capital asset pricing model. Rj is a required return on asset J. Rf is risk-free rate of return, commonly measured by return from government financial instruments such as government bonds. Bj is beta coefficient or index of non-diversifiable risk for asset J, and Rm is market return. Risk market minus risk-free is also called as market risk premium because it represents the premium the investor must receive for taking the average amount of risk associated with holding the market portfolio of assets. That's all from this session. I hope you can learn a lot and find something useful for you from this course. I will see you soon for the next part. Bye!